Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith, and here are three things you need to know this morning. Stocks are closing out a huge first half. The Nasdaq poised to make history with its best January to June performance ever. It's up around 30% since the start of the year, easily outperforming the other benchmarks. The S&P 500 hasn't missed out on the melt-up. Of course, it's on track for its best first half since 2018. It's heading for a third straight quarter of gains. The big winners, of course, they've been the AI plays. NVIDIA, most notably, it's up over 180% this year with a valuation of a cool $1 trillion. Triple that, though, and you're in Apple's territory. The tech giant edging toward that unprecedented $3 trillion market cap milestone this morning. Inflation is easing. The Fed's favorite measure of price changes showing the lowest level of inflation since April 2021. Core PCE rose 0.3% on the month in May. That's down from the previous reading, with the headline number showing an even more pronounced slowing. The data will no doubt impact how the market sees Fed policy playing out from here. The central bank was seen on track to return to a quarter-point rate hike in July. And Nike shares trading lower after its first earnings miss in 3 years and underwhelming guidance for the first quarter. The sports apparel giant beat the street on the top line, but profits came in lower than expected, thanks in part to squeezed margins. It's been a rocky year for the stock, with analysts cutting price targets in recent weeks. A consumer slowdown in the U.S. and growth stalling in China have been big areas of concern for investors. The signs have not been great generally. Big wholesale partners, including Foot Locker, have been cutting fiscal year guidance. Nike's CFO says they are closely monitoring the macro environment.
Well, it's a key trading day this Friday morning. We're closing out the second quarter and the first half of 2023. All three major indices are on track to log gains for both periods. But as you can see, the Nasdaq blew the other indexes out of the water, up just about 30% year to date. Few strategists have predicted the market's strength in the first half of the year, and even fewer have predicted how narrow the rally would be. So let's break down what happened so far this year. And even as you're taking a look at some of the major averages this morning out of the gate, of course, Julie, this comes with the added context here of what we've seen for the Dow, the S&P 500, and the Nasdaq. We've got that loaded up on screen here for our folks at home as we slide on over to the Wi-Fi interactive here.
It occurs to me we don't have the percentages up here, but luckily I know them.
Hey.
Yeah, here we go. The
morning.
Nasdaq is up about 30% on the year to date. The Nasdaq Composite, that is. The S&P 500 is up, around 14.5%. And the Dow is up less than 3% on the year. So that really shows the real divergence that we have seen. And it's shown the theme that we've talked so much about, that it is large cap tech that has really dragged the rest of the market along. But we haven't seen that broad participation. If we look at the Nasdaq 100's return for the year to date, that even more concentrated bunch of stocks, you have the same situation. So the Nasdaq 100 up even more, about 36% for the year to date.
And this comes off of a year in 2022 where the mighty had fallen. Those mega cap tech stocks had taken a blunder, especially given the Fed's very hawkish and rapid pace of tightening. And so as we continue to move through what is now a decelerating period in the Fed's tightening and policy pathway, there is still more work to be done, as the Fed had shown earlier this week. There's a few other areas where the Fed has impacted. The Fed's impacted yields as well over the course of this year. And it's been interesting to see exactly where investors have placed a lot of their own, perhaps portfolio plays, based on where the Fed would continue to be more hawkish around their yields. We're taking a look at some of the 10-year T-note yields, and over the course of this year, I mean, you can exactly see, given where the Fed has shown the inclination to have a terminal rate as well, and set that and give the market some expectations, even though there's been some of the conversation about which is wagging which, whether it's the Fed wagging the markets or the markets wagging the Fed. There's still a very clear tenor that had really transpired within the yield progress we'd seen over the course of this year.
Yeah, but when all is said and done, the yields have moved surprisingly little. I mean, yes, there was a lot of movement in between, but at the end of the day, where we started the year and where we are now is not that different when it comes to yields. We do have some strategists now changing their strategies on yields. JP Morgan, for example, pulling back on a short-term bullish tactical call that they had on 10-year treasuries, which is interesting. So we definitely see people repositioning into the second half of the year. But to dig into what we have seen sector-wise and stock-wise, we want to take a look at the Wi-Fi Interactive as well to look at what we have seen. So just want to quickly hop on over to our heat maps here. Let's start with the Nasdaq 100, why don't we, and look at the year to date. Because again, this puts a fine point on what we were discussing, which is the vast dominance of large cap tech, which is kind of in your quadrant, if you will, Brad.
Yeah, and so focusing in on this quadrant, and if you were to highlight a few of the players and what they have discussed that's really given them a lot of fanfare or at least pushed investors in their direction, think about NVIDIA here. You're seeing that up year to date, up by about 180%. Now, that's the intraday move here, but year to date, there you're taking a look at that move, and much of the conversation there has really centered around generative AI. You think about some of the other companies that have benefited from that as well. Microsoft was one of those. Even though that's up only about 40%, it's still a significant move, but compared to some of the rest of the mega cap tech stocks here on the year, there have been considerable moves in NVIDIA, Tesla, even as some out there on the street, some analysts try to annex an AI play there. We'll see if that proves out. And then Meta as well, as they try to figure out what their generative AI play is while dampening down the spending that they had done on the metaverse as well.
Right, exactly. So just domination by large cap tech. Real quick, want to look at the sectors for the year to date as well. Utilities, energy has really gotten beaten up this year. Healthcare as well. And then predictably, you've got XLK, tech, XLC, communication services, XLY, consumer discretionary, that are the best performers this year. So given all of that, given what we've seen in markets, we also want to take a beat and talk about the economic outlook and what has driven gains in the first half of the year. So let's talk about the economic data. The Fed's preferred inflation metric was out this morning, and May's reading on personal consumption expenditures, or PCE, tumbled last month, reaching its lowest level since April of 2021. So progress here. Headline PCE, which includes more volatile food and energy prices, rose just 0.1% last month. The cost of goods year over year up 3.8%, down from its 4.4% surge 12 months prior. And after a surprise upward revision to first quarter GDP showed the U.S. economy is stronger than Wall Street thought. Seth Carpenter, Morgan Stanley chief global economist, joins us now. Seth, it has been so interesting to talk about the recession, and talk about the recession, and talk about the recession, and then look at data that by and large has shown the recession is not yet arrived. What is going to be the narrative on this front in the second half of the year? Will we continue to see resilience?
I think so. So one point that I think is really important is that we have, since the Fed started this hiking cycle, been calling for a soft landing in the U.S. economy. The labor market is one of the key stories so far this year. There has been clear slowing. However, the rate of job gains has been pretty strong, and we think that's been contributing to resilient spending. We think that also means that as things do cool down with the Fed rate hikes, we're just not likely to tip over into recession. And so we feel pretty good about the fact that we've been not calling for a recession for quite some time. What happens for the rest of the year, though, I think is important. Job market is strong, but it's slowing. Spending has started to moderate, especially the big gap we saw with the difference in spending on goods versus services. So we do think the economy is slowing, but as the revised data show, as all of the incoming labor market data show, we're still in a pretty solid place for now.
And so what we had heard recently from Morgan Stanley as well is that the S&P 500 would slide 9% by the end of the year. Is that still some of the kind of consensus, and what in the economy would be the kind of larger outlier effect that would push the markets like that?
Well, I think, it's a really tricky situation here. So we are looking for more slowing in the economy over time, over the rest of the year. And I think my colleague Mike Wilson, in this call for the S&P 500, says we got to look at that slowing in earnings and reflect that in the price. I think earlier you and Julie were talking, and you mentioned how narrow some of the rally has been. And I think that's been another one of Mike's theses, is that as an index as a whole, it's been holding up really strongly and continuing to rally, but it's been pretty narrow. And so I think when you think about Mike's view of the world, about how equities have to price in the slowing, our view of the world, that not only is the economy slowing, but the Fed is likely to hold policy rates higher even as the economy slows. That's sort of how you get those two views to come together.
Seth, let's talk about the Fed view and the central bank view a little bit. You had a front row seat, I guess, to that kind of a view. I believe you were in Sintra, Portugal, where the central bank chiefs have had that very closely watched panel. And, we were watching it from afar, of course, and watching from the headlines. I wonder about your impressions from in the room and how that's sort of informing how you're thinking about the central bank action for the rest of the year.
Absolutely. I was there in Sintra. It's a great conference, and you have a lot of central bankers from around the world together talking about the topics of the day. So surprisingly, inflation was front and center. How far they have to go was part of the discussion. But I think the key nuance for me was the commitment to raising rates was less dogmatically about what level they're going to, more about we're going to do what it takes to bring inflation down. And in so doing, it increases that phrase that we hear all the time, data dependency. So they are going to be scrutinizing all of the data as they come in, trying to assess, have we done enough? Do we have to do more? Or heaven forbid, have we done too much?
Are there any shocks that you would kind of anticipate in the second half of this year coming from rate policy from other parts of the world that could bleed into the U.S. economy?
Well, if I could anticipate them, then they're probably not going to be a shock. But look, I mean, what's really interesting this cycle is how fast the hiking cycle has been. And I think across the developed market world, what people are still in markets internalizing is that this cycle really is different than all the other cycles we've seen for at least the past 35 years, in that the Fed, the ECB, the Bank of England are intentionally trying to suppress growth to bring inflationary pressures down. Whereas in previous cycles, what we've seen is they're raising rates as the economy continues to grow and as maybe inflation starts to creep up toward target. But as soon as there's softness, they start to cut rates. This time will be very different in that regard. The second way in which things are quite different is the emerging market economies compared to the developed market economies. EM central banks actually got out in front of the developed market economy central banks. And now we can look at the Central Bank of Brazil. We can look across many of the Asian central banks, the Bank of Indonesia, for example. Now the question is, when do they actually start to ease policy because they got out ahead, they did their homework first, and now they're at a different point in the hiking cycle.
Seth, what would happen if the Fed did not raise any more at all? What do you think? Do you think inflation would just come down on its own?
So I do. I think we would definitely see further fall in inflation. We know, for example, in rent inflation, which accounts for 40% of core CPI, the raw data point to continued further step down in inflation there over the rest of the year. Goods inflation, with perhaps the exception of autos, is showing this disinflation and perhaps even some deflation because global supply chains have gone back to normal. And even other services outside of housing, one of the places where Chair Powell likes to point, that's actually been behaving reasonably well for the past couple of months. So I do think we would see further disinflation. The Fed's question, though, is would we see inflation come all the way back down to target over the next couple of years? And I think that's where there's a lot of uncertainty, but I do think they're already in restrictive territory. And so we would continue to see further disinflation.
Is it possible for inflation to come back down to target without any type of major detriment in the employment situation, which has remained fairly solid?
Yeah, exactly. So yes, I think the answer to that question is a clear yes. There's definitely a path there. Listening to Chair Powell this past week at Sintra and what he's been saying over recent months, listening to some of the other Fed communication, a so-called soft landing is, I think, their baseline scenario. It's been our call for quite some time since this hiking cycle started. And one of the keys there is, in fact, this very strong labor market. So we are seeing job openings come down, but we're not seeing a lot of firings. And I think that's reflective of the fact that you can get a slowdown in the economy, an easing of pressures without there having to be really an outright contraction or a hard recession.
Seth, stick around with us this morning. We've got much more to discuss, but we got to switch gears here as we're tracking one major apparel and retail company Nike shares trading lower after earnings missed estimates. Slower sales growth and lower margins weighed on profits in the quarter, fueled by both higher input costs and ongoing discounting efforts. Soaring China sales, however, were a bright spot for the company, even with the near-term uncertainty from slowing consumer spending. Our next guest remains overweight in the long term. Adrian Yee, who is the Barclays Consumer Discretionary Analyst, joins us now. Adrian, always a pleasure to get some of your insights around Nike and perhaps just on headline. You look at the report, you hear from the executives on the call last night. I just wonder, broad strokes, what jumps out to you the most?
So broad strokes, what jumps out is this was largely expected, not in the consensus numbers, but one could assume that a lot of the numbers that came out, particularly on the fiscal 24 annualized guide, were roughly in line with sort of buy-side expectations. So we knew that, the stock since last quarter had underperformed the S&P grossly. It was down about 12% since they last printed. So the notion that there was something wrong in wholesale, the notion that Macy's and DBI were making announcements about kind of recapturing, wholesale business, those were all very well known. In fact, Nike had in their past quarter had already sort of signaled that there was going to be a moderation, and by moderation, that means slightly negative, in that wholesale channel. Remember, the past 3 consecutive quarters, they've been restocking, aggressively restocking. What that means is that you're shipping those items, and when you ship them, you book them as revenue. If people have them earlier and they've restocked for a longer period of time, say 6 to 9 months, then they don't need to buy them in subsequent quarters. That's really the big piece of it. The second big piece and bigger piece for the long-term investor really is this China recapture. So China went from a 1% constant currency growth last quarter down from 5%, right, the prior quarter with all this disruption, to an up 25% constant currency. If they can hold on to that double-digit growth rate through the rest of the year, it's very possible they recapture or start to head back and recapture some of that $1 billion, right, that they've lost since the PR announcement a couple of years ago.
Hey, Adrian, it's Julie. It's good to see you. One of the other things that sort of caught our eye or our ear, I guess, from the call is the strength in Jordans, which were up in the mid-30 percentage rate across men's, women's, and kids, according to Donahoe. How do they keep doing so well in that brand? I mean, listen, you've covered retail for a long time. It's really difficult to have a blockbuster brand or offering with endurance. How has this managed to do it?
So brands that endure, they are not about the style of the moment, not at all. They're about the emotion, right? They evoke emotion and passion for the brand, be it Lulu or Nike itself or Jordan. So the consumer comes in, they put on a pair of Jordans, they think they can jump, 10 feet high.
I can.
You can, exactly. I've seen you. But that's what you want. You want people to put on the footwear, put on the apparel, and feel like $1 million or feel like they can go conquer the world. That's an enduring brand. And that's what Jordan is putting forth into the marketplace.
Do you believe...
They also have great product, great innovation. But behind that is the emotion.
It sounds like you own a couple retro pairs of Jordans yourself, Adrian. All that considered, does that make this brand of Jordan within Nike perhaps any type of economic indicator for the consumer environment more broadly?
What I would say is in any economic downturn, any recession, it's the 80-20 rule, right? Well, I should say the first thing is that an ebbing tide, everybody kind of goes down a little bit, right? The best brands, if they were going to put up upside, they're putting up in line, right? The worst brands are going to start missing. So an ebbing tide in a slowing economic environment definitely impacts people all around, but it impacts them at very, very different levels. And so then you get to the 80-20 rule. Within any economic recession, there are 20% of the brands that have that halo, or it's their brand moment, right? It's the cycle time for them. And so to the extent that there's a few of these brands, Jordan included, I mentioned a couple others, there are absolutely going to be those brands that continue to perform and actually accelerate and sort of beat the general kind of malaise in the economy.
So Adrian, I know you're an overweight on the stock. So it sounds like you didn't hear anything in this report that would change your view that people should be buying this.
So there are 3 things that I would say if you're contemplating buying this. So the it's trading off about 2% in the pre-market. So let's call it around 110. We are looking at numbers have come down, right? The implied EPS is somewhere in the 370 range on a fiscal basis. Calendar next year is going to run in about the $4 range. And this stock, in its worst of days, traded down to a 21 PE multiple. So let's just say that somewhere between 22 and 25 PE multiple. Downside, you're looking at $90. Kind of if you're kind of a medium downside, it's about 10% from here. If you're in the mood to kind of like dollar cost average and get into this name for fiscal 24, or I should say calendar 24 and beyond, then you should do so. The three things that I care about coming out of this print: number one, wholesale, right? That overhang, well, it's known, right? We were all worried about it. Okay, now they finally said it, right? It's going to be down mid-single digit for fiscal 24. Number two, we were worried that China was only going to be up 10%. That's not that sexy. It was up 25%. Okay, so that's, from a long-term investor, that's a good data point. And then the third piece of it is just, the Q1 guide, right? Really, it was 30% lower. And that's, I think, what really kind of is pressuring the stock, and it's kind of down 2%. That was a surprise. But the fact of the matter is you have wholesale coming down at the same time that they need to spur demand and invest in demand creation. And so you kind of have this kind of weird moment in the first half of the year where you're not getting your freight recapture, your promo recapture, your China accretion, right? Accretive margin. Those are all coming. So those are the three things that I would consider. About 10% downside from here. And I think you're okay. I mean, Nike is still one of the best brands. At some point, they'll come out of this wholesale cycle.
Adrian, while we have you, I mean, you've covered Nike for a long time and seen consumer responses to marketing messages and campaigns. You've got some companies out there that are in the throes of controversy because of their wavering on commitment to social issues. For Nike, this was a company that went out very early on with Colin Kaepernick and stood by their messages and the marketing, and also what their commitments look like on the spending front and donating and philanthropic efforts as well. Is this a case of how a company could get their commitment to social issues right, and how the stock can also benefit?
What I would say, each of those issues that you mentioned had a near-term impact, and sometimes they were good and sometimes they were bad, right? I mean, the PR issue, was I don't want to bring it back up, but that was not a great one. What it says to me is that the company has a very, very firm moral grounding, and that there are some places where they're not willing to get pushed on, and that their commitment to a lot of these ESG initiatives is unrelenting. And so what I would say is, even in the near term, these are the types of things that these are the companies need. The largest companies in the world need to stand for the right things. And if you do that over the long term, over a compounded period of time, you will win, right? So to the extent that they're doing the right thing, operating the business correctly, and what we've always said, that this generation, millennials and Gen Z, and those to come after them, are much more sensitive about spending their dollars as a vote of confidence in what that company is actually doing from a moral standpoint, as well as from a product standpoint. So if you can get the hot brands with, a good corporate kind of messaging, I think you win in the long term.
Adrian, always great to get your perspective. Appreciate your time this morning.
Happy 4th.
Happy 4th to you.
Happy barbecue. I'm coming over.
Okay, well, look, and we have the same color on. We're ready to go. We're ready to be patriotic together. Adrian Yee, Barclays Consumer Discretionary Analyst. Appreciate it.
Thanks so much.
Well, Nike's muted guidance for the year will fuel fears perhaps of a cautious U.S. consumer as we head into the second half. For a look at the consumer in the U.S. and globally, let's bring back in Seth Carpenter, Morgan Stanley chief global economist. And obviously, Nike is just one example, right? We have seen the broader trend, at least in the U.S., of goods spending moderating to some extent, services spending ramping up. How does that particular aspect of growth play out in the second half of the year?
We think broadly that pattern of the slowing in goods spending, the rise in services spending, getting back, if you will, to more normal patterns that were completely distorted during COVID, that's mostly played itself out. And now we just look for general slowing in overall consumer growth over the second half of the year as we look for continued easing in the pace of job gain. So it's really going to be getting back to fundamentals, getting back to a labor income driven spending outlook. And we think that's going to continue to cool over the rest of the year.
And then additionally here, I mean, we're just kind of thinking throughout the rest of the year, where is some of the spending expected to normalize? Where for companies who have been looking across where those consumer dollars could be banked on, they're still going to have to spend in marketing efforts. They're still going to have to make sure that they are engaging with the consumer in the correct way at a time where consumers are saying, in certain categories, we just don't need any more grills.
Yeah, no, I think that's fair. I think one place where there still is some residual strength in terms of consumer demand, and I will give a strong shout out to Ellen Zentner, our chief U.S. economist here at Morgan Stanley, is in automobiles. So we were talking a little bit about inflation before, and one area where inflation hasn't come down as much has been in automobiles. The amount of pent-up demand, if you will, for automobiles, if you look at historical patterns with job growth and income growth, it still looks like there's a lot of residual demand there that's going to keep automakers busy for a little while now.
All right, Seth, stay with us. We've got just a little bit more to discuss with you. China's economic recovery, that continues to stumble here as the world's second largest economy reported disappointing factory data for the third consecutive month in June. The Manufacturing Purchasing Managers Index, or PMI, that inched up to 49. That was from 48.8 in May, but remains below the 50-point mark, keeping it in contraction territory. Meanwhile, non-manufacturing PMI fell, indicating a slowdown in services activity and construction. China's GDP grew rapidly in the first quarter, but data from Q2 has not kept up with that initial pop. Still, Morgan Stanley forecasts a pickup in the nation's economy, with growth rising to 6% in the second half. Let's bring back in Seth Carpenter, Morgan Stanley chief global economist. Seth, what would be the catalyst for some of that pickup in the second half?
Yeah, I think right now there are two key factors for us to get that stronger second half growth. The first one is that the resurgence in consumer spending after having had such tight COVID lockdowns for so long. We saw that big pop in Q1. It moderated a bit in Q2, but we think there's more to go there with consumers satisfying their pent-up demand, especially for domestic spending, especially on services. The second one, though, is, as you noted, we're getting a whole string of soft data now in Q2, especially from the manufacturing sector, if you will, the sort of old China economy sector. And we're looking for more policy stimulus to come out of Beijing. We've seen some relaxation of the restraint to the housing market. We've seen some easing from the central bank. We think we're just going to see incrementally more policy stimulus coming out of Beijing to really shore up those parts of the economy that are foundering.
Seth, as you guys point out in your note discussing a rebound in China, you also point out that there's a hot debate over whether it is indeed going to see this kind of reacceleration. Like we talk about the debates here all the time. It sounds like that one is equally, if not more heated. What do you think is the crux of investor confusion when they look at China and whether indeed we are going to see this reacceleration?
So I think there are a few contributing factors there to the overall market bearishness. The first one is just the plain facts. Q2 is very soft in China, or has been very soft in China, and there are no two ways about that. So that's not a topic of debate, and anyone can see that fact in the data. I think on top of that, however, there is also a lot of investors had plays on China, especially in the first quarter, looking for that China reopening trade. People have said over the past 25 years, we've seen periods where China accelerates. Let's try to capitalize on that. Our view has been it'll be a very different cycle, and it has been a very different cycle, so much more focused on domestic spending and on services that most investors' typical China plays didn't work out. And I think that compounds the bearishness. And I think the last part is, unquestionably, once we get beyond this year and next year, where there's a cyclical strength to it, there is a secular longer-term slowdown in China. And I think a lot of people in the markets now are saying maybe the slowdown that we're seeing now is actually that structural slowdown, and that exacerbates the bearishness for the near term.
In some of the behavioral shift behind the slowdown in services, where is that kind of leading into other product categories among consumers right now? Are there areas that are kind of jumping or sticking out or outperforming?
Yeah, I mean, we do think the focus really should be on services spending in the Chinese economy, and that fact, more spending on services than historically has been the case out of spending, that helps to explain why there is less of a spillover to the rest of the world of the Chinese acceleration in the first quarter of the year. And we also think even if we are right and we get this acceleration in the second half of the year, investors may be once again disappointed because that spillover, those betas to the rest of the world, are just not going to be anywhere near the size that people are used to.
Seth, great to see you. Thank you so much. Happy holiday weekend to you. Seth Carpenter, Morgan Stanley Chief Global Economist. Appreciate it.
Thank you very much.
Well, we just had the opening bell on Wall Street, so let's do a quick check of the markets. It is the last day of the month. It's the last day of the quarter. It's the last day of the first 6 months of the year. When it comes to the trading that we have seen, as we've discussed, it has been stronger than anticipated performance for the major averages, particularly for the Nasdaq. And for the moment, we are ending the last day to the upside. The Dow gaining 0.5%, the S&P up 0.75%, the Nasdaq up 1% here. We have seen economic resilience. We have seen, even in the face of the Fed raising rates, that stocks have managed to gain. It's been an interesting 6 months, Brad.
It has been. It's also the last day of the week before a holiday abbreviated week as well. And taking a look at the Dow Jones Industrial Average, which is, as the OJs would say, also living for the weekend. Year to date, you're seeing it only higher by about 3.5%. We'll see how things end out the day. But here at the gate, we're higher by about 0.5%. We'll round that off to Nasdaq Composite. You're seeing that up by nearly 1% here out of the gate this morning. Year to date, holding on to gains of 31%. S&P 500, you're seeing that up by about 15% over the course of the year-to-date scale. And today, right now, early in trade, up by about 0.8%. So let's take a look at some of the major sectors here. 11 sectors, we've got them lit up for you here on the screen. That's the year-to-date activity. We gave you that context earlier, but let's take a look at here and now, as Luther Vandross would say. XLK, Technology, whatever you want to say, it's up by about 1%. I didn't think I'd make all that rhyme, but hey, here we are. Utilities, that's still higher, pulling up the caboose, but it's still up. So all 11 S&P 500 sectors are in positive territory, and only 2 of them really outpacing the broader gains for that actual average, and that is technology as well as communication services. Let's take a look at some of the technology here, since we mentioned that a moment ago. Major cap tech stocks and Apple. We want to zero in on this one. Yeah. Is it a $3 trillion company? You bet your bottom dollar it is. Let's put this on that market cap. And there you're seeing just above $3 trillion in market valuation. We've been tracking this one for, my goodness, since the Obama administration, seems like.
Do we have some sort of confetti or something that we should drop on us?
Hang on, just give me a second.
Oh, there we go. Oh, little fireworks.
Yeah.
We tried. No. Indeed, Apple 3 trillion. We got there.
We did it again.
We did it, you and me. All right, we got all. Thanks so much, Brad. We all got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Are we going to see a recession this year?
Oh. Good question. Comes up a lot. I'm going to say for 2023, not likely. 2024, more likely.
I'm going to say that we will know if there was a recession this year after the NBER declares that there was a recession that we entered into this year, which will likely come well after the fact.
Fair enough.
Apple's market cap has indeed hit $3 trillion. Remember, we were watching the number to beat, as it were, on a per share basis, 190.74. Obviously, it is above that level right now, and it was sort of inevitable, feeling like that it would get there. It was just a question of when. This is the first company ever to hit a market value of $3 trillion or more.
Let's talk about the significance, some of the catalysts that have gone into this. And our own Dan Halley, our tech editor, was out at WWDC when we saw a concerted move to the upside in the stock. The shares were reacting on a few things, announcements that had everything to do with services, the operating system, a few new products as well, and the Vision Pro and what that could be for the company. He also brought back a couple of great souvenirs and a hat for me. I appreciate that, Dan. But also, as we think about what the services business has been to this company in terms of margins, you're looking at a year, and we're amidst a year where you could see this finally become an $80 billion business in just services alone. High margins, they engage with consumers. That makes the environment and the ecosystem that much more sticky for Apple. And as they continue to roll out even more hardware, it makes the software play or the services play that much more profitable for them, as there are new realms that they can continue to really monetize that relationship with the consumer.
And even as the stock rises, there is more bullishness surrounding it. Yeah. The latest this morning, Citi initiating a buy rating on the stock with a $240 target price. So just to put that in perspective, we're under 192 right now, so they're looking for it to move up even more to 240. I got to do the math on where that would put the market capitalization. But basically, the analyst there is saying that Wall Street is underestimating continued gross margin expansion, that this company can be even more profitable as time goes on, which, given its size already, is impressive indeed. The analyst over there, Atif Malik, over at Citi, initiating coverage.
Absolutely. All right, we're going to continue to track shares of AAPL as we go into the weekend as well.
Yes, we are. We also are watching shares of Constellation Brands this morning. Shares of the beer maker slipping about 2.8% after reporting first quarter earnings. The company did beat analyst expectations on the top and bottom line, but margins contracted thanks to raw materials costs and marketing spend. The company's beer sales up by 11%, driven by strong growth for Modelo Especial, which just took Bud Light's place as the best-selling beer in the U.S. Will those gains be sustained? We shall see. I believe that the timing of their conference call is a bit unusual. It's this afternoon. They were out with earnings this morning, but I imagine it will that Bill Newlands and company will get some questions about Modelo, about sustainability of that brand, about some of the issues at Bud Light, and whether they can continue to capitalize on those.
Yeah, well, the conference call being at that time perhaps gives them time to crack open a few cold ones, and then for the effects to waver off or peter out.
I don't know. That would be a more fun conference call than most conference calls if they did indeed crack open some product.
Yeah, they should just send a pack to everybody who's going to be asking questions on the call too. Every analyst.
Idea.
I know, right? You guys can have that one for free. I won't even take commission on that one. Wine and spirits business that delivers strong relative performance as well. They mention across the higher end wine portion of the portfolio, outpacing some of the corresponding segments of the U.S. wine category. They mentioned in dollar sales growth at least. And then additionally here, as they're looking forward, going forward from here, they reaffirmed their fiscal 2024 cash flow target. That's going to be at about $2.4 to $2.6 billion. Free cash flow projection, $1.2 to $1.3 billion. And they updated their outlook for EPS as well. They brought that in at $9.35 to a top end of $9.65 as well.
Yeah, just real quickly, they might have talked about being encouraged by wine and spirits, but the sales number did miss analyst estimates by a bit. So beer was stronger, wine and spirits not as strong versus what analysts had been anticipating. And then we have another mover for you. That is XPeng, the EV maker, Chinese EV maker, surging today after it launched its new G6 Coupe SUV in China, coming in at just under $29,000. That's below the price for Tesla's Model Y, which is currently around $30,000 in China. And analysts were positive here on the pricing strategy for this new vehicle.
I mean, look, I've never ridden in an XPeng. I would love to. I would love to give it a shot. I have no doubt our own Pro Supermanian has taken a ride in all of these before. But, you know, as you think about where this market in China is getting that much more competitive, whether it be on some of the U.S. or European companies that are trying to set up camp to be able to produce and then directly deliver within that region, Tesla has certainly been very vocal and very out front about some of their ambitions there, and especially in this EV landscape too, as you have now a region that is placing more mandates in focus and in operation for some of the traditional combustion engine companies that are in that region, in the Greater China region, XPeng, as well as Tesla and some of the other pure EV plays. It's going to be interesting to see how they can be able to maintain their own market share while there is increasing production mandate from some of the larger entities that have been in the region for decades.
Yeah, I mean, when it just comes purely to the stock, the likes of folks at Citigroup, while they're encouraged by the pricing of this product, they say the valuation is too steep for them right now, even though you can see what the stock has done over the past year.
Yikes. All right, lastly, we're keeping our eyes on Carnival Cruise Line stock. I've never been so excited to talk about cruises since this week. Shares, they're popping today after Jefferies upgraded the stock to a buy and raising its price target to $25 from just $9. The analysts cite recent leadership changes as a major boon for the company. Josh Weinstein taking charge as a CEO less than a year ago. Jefferies points to Weinstein's efficient reporting structure, sales and marketing effort, and push for increased cash flow as major positives for the cruise lines business. Shares are up on this by about 5.5%. And if we could take a look at the year-to-date performance for Carnival, because like one of its peers in Royal Caribbean or Caribbean, you're seeing Carnival up 124% year-to-date. And so it's this resurgence of demand within the experience economy, and for a lot of the consumers that have been waiting to finally take advantage of trips that were either pushed back because of some of the restrictions on when cruises could set sail, how many people could be on the vessel, what type of restrictions had to be in place. Now it's just jolly ho, and you get on the cruise line and you can move about the cabin anywhere you want to go, essentially, and make sure that it's one big party. And I think people in this kind of cruise experience, I've never been on one, but they always rave about you just not having to be concerned about driving anywhere or, you know, any extra lift. You just get on there, they hand you a drink, you're off into the races.
I was just doing a little quick math on my phone. So the price target here, it's the highest on the street.
Wow.
From this analyst, it's $25. That is 45% higher than yesterday's close. So this is definitely reflecting some optimism here about Carnival.
I saw you out of the corner of my eye doing all that.
You were like, what
on
is
your
she
phone
doing?
calculator. It was impressive, yeah. We've got all your markets action and even more phone calculator action straight ahead. Stay tuned. You're watching Yahoo Finance.
Lastly, we got to end on a serious note to get us ready for the show today. Is the Fed about to cause a summer of chaos?
No, I don't think the Fed is going to cause a summer of chaos. I think more likely there'll be other things caused if there is a summer of chaos, but I don't think it's going to be Fed this summer because they've been quite upfront about what they're going to deliver in terms of policy, at least for this summer.
The Nasdaq Composites rally this year defied Wall Street expectations. The index up more than 30% year to date. And while we're hearing a lot of discussions over mega caps concentration, there's a surprising assortment of first half winners that investors aren't talking about. Yahoo Finance's Jared Blickery. He's live over at the New York Stock Exchange with the details. Hey, Jared.
Hey there. Well, for this rally to continue, investors need to be able to bet on more than just those concentrated stocks. Fortunately, a new basket has emerged over the last month, really playing the game of catch-up. I want to direct everybody's attention to the Wi-Fi interactive here. First, I'm starting out with the Nasdaq 100 and the year-to-date price action. You know, we've seen this screen a lot of times. Apple finally hitting $3 trillion today, but I want to show you what's happening, not at the sector level, but at some of my leaders level. And I have ETFs as proxies for various sectors here. In the upper left, Baito is a Bitcoin ETF. Guess what? Over the year, that is the #1 performing instrument, followed by chip stocks. We know chip stocks, big part of the bubble story, so not a surprise there. But this is a year-to-date view. Let me give you a month-to-date view. And you might be surprised to see that home builders, IXIC, that's in the upper left, that is the leading performer over the month, followed by meme stocks. And we have retail, transportation, ARC, that's disruption, IPOs. Guess what? I'm sitting here, Savers Value Village, coming to market, listing here this morning at the New York Stock Exchange. We saw Kava come to market just a few weeks ago, 100% pop on the opening print there. So really a lot of money that was on the sidelines arguably is coming in and picking up the fringier parts of the market that I like to call. Following IPO, we got KWeb, Baito. KWeb is Chinese ETFs, is a Chinese ETF. Baito, again, Bitcoin. Then we got defense, chip stocks, momentum, all of those outperforming the S&P 500. So let me just give you a picture of some of these sectors that I'm talking about. And here's another one, regional banks. Regional banks have really bounced back. This is what it looks like month to date. Contrast that with year to date. There's still very few pockets of green here. Bank of the Ozark, that's up just nominally, and a couple others, but for the most part, still sitting on some heavy losses for the year, but playing catch up. Here, let me go to another heat map and we can do the transports. These are the companies that are bringing us the stuff that we need, as well as carrying people. We see Delta Airlines, that's up almost 30%. United up 15%. The railroads up nicely. FedEx up 14%. Similar situation with industrials, defense stocks. By the way, I'm going to go back to industrials. Remember GE? GE coming up with a blockbuster year. It's one of the top performers in the S&P 500, up 66%. Here's a 10-year chart, and you can see barely climbing back to the middle part of that range there. But let me just finish this by going to, I wanted to show you home builders as well. Here's what's happened over the last month. A couple of these names, W up 61%, Wayfair. And then you take a look at retail as well. We've really seen some of the stragglers come in over the last month, and that all gets back to that non-farm payrolls report that we were looking at earlier in the month. You combine that with the tame inflation numbers that we're seeing this morning. Hey, maybe there's something to look forward to in the second half of the year in terms of stocks. Need this rotation to continue though, the breadth expansion.
Yeah, well, we'll see if that ends up happening, Jared. That's what everybody's waiting for the second half. That's one of the big questions about the expansion of the rally. Thanks, appreciate it. Speaking of which, mega caps have dominated gains this year, but could small caps be the sleeper bet of the summer? The small cap Russell 2000 index, it has risen more than 7.5% this year. Not as good as the S&P or the Nasdaq, but it has been gaining momentum as of late. So let's talk about what we could see from here. Let's bring in Quincy Crosby, LPL Financial Chief Global Strategist, to weigh in. So Quincy, I know that small caps are among the areas that you are watching. It's good to see you. Do you think that this is an area where investors should be looking right now as they await the maybe coming broadening out of the rally?
Well, you know, we're just following the small and mid cap as a barometer, not necessarily as an investment, but clearly it is helping at least assuage fears that this market is only being led by 8 mega cap stocks. The other thing about the small and mid cap is that the risk profile is actually riskier and more volatile than the S&P 500. So when you see a turn, and it's been on a number of days, it's not just, you know, a one-off. They'll become overbought, they'll rest, and then they'll come back. But it also suggests that, as you alluded to, the small and regional banks that populate the Russell 2000, that at least for investors, and by the way, we believe this is being led by managers, portfolio managers, that they believe the worst is over. Because if you didn't believe that, you would certainly not see the advance in the Russell 2000. So that's a positive. The industrials in the Russell 2000 also performing well. Even on the large cap basis, the industrials have been leading. The home builders, the defense stocks, machinery, infrastructure names, helping the industrials do very well. They've been sort of the engine that could in this rally, x the mega cap names. But the small and mid cap, they are volatile, and if they start to suspect that we are close to a recession, they will sell off very, very quickly. So again, as a barometer of what is being signaled by that Russell 2000, it actually is quite positive at this point.
Quincy, when you spoke about some of the portfolio managers who were kind of forced to participate in the tech rally and the mega tech rally, does that also mean that those same portfolio managers will then trigger perhaps some significant downside movement if they're forced to now rotate back into small caps?
Well, I don't think that it's so, the channels are so differentiated. I don't think they're going to go into small and mid cap. But the fact is that when you get to the end of a quarter, when you get to the half year mark, if you are lagging in performance, you are going to go into the leadership. And you're going to do it regardless of your commitment, regardless of your conviction. You are going to go in. And if you don't go in, your risk manager is going to tell you, you can't be lagging this much. So normally what we see toward the end of the quarter, or the half year, especially the half year, is this push in. The big tell will be actually when we come back after the 4th of July, when the trading desks are filled, whether or not these managers stay in the now high valuation part of the market.
Do you think that folks should stay invested here? Or where are you recommending that people go in this market?
Well, we still like fixed income. We like the short duration part of the treasury market. You can still get over 5%. We like preferreds, particularly on the large money center banks, especially after the stress test came back, that they are all passing and doing well. And then in addition to that, in investment grade corporates, those are attractive, again, short duration. People have been saying, Quincy, what about the high yield? Well, the high yield spreads are actually pretty tight, considering that the headlines have been screaming recession. But why take on that risk at this point? We suggest going into the high quality names, but certainly the industrials at this point. By the way, if we do hit a recession, statistically, the industrials actually start to pull out first, as the market sees rates coming down and the Federal Reserve beginning to think about cutting rates.
Quincy, you talked about why taking on the risk in high yield in particular. Are there areas in the market where you do think it is worth taking a risk? Are there sort of higher beta areas that are interesting to you?
Well, we are not advocating this by any means, but I can share with you that many portfolio managers are looking at the fallen angels. They believe that the fallen angels are offering an attractive yield, and that we are close to the end of the Fed rate cycle. Most likely at this point today, we're seeing, yes, still a rate hike for the 26th of July. But for the September meeting, the odds, the probability has come down a bit after today's report. So that would suggest that if it continues to show that the core PCE deflator continues to come down, maybe the Fed does not come in September. But again, the beneficiaries will be the fallen angels, because they're pretty good companies. But again, if you are thinking that there's a recession coming and an impending recession, you are going to be very leery of it. So we're being conservative, we are in kind of watchful waiting, and we're happy with our architecture, so to speak, going into the second half.
Quincy, good to see you. Have a great holiday weekend. Thanks for joining us.
Thank you so much.
Thanks. Quincy
Yeah, thank
Crosby,
you.
LPL Financial Chief Global Strategist. We've got some great interviews on tap in the next hour. Why one strategist is telling investors to embrace the uncertainty. It sounds very zen. We'll speak with Evercore ISI's Julian Emanuel in the next hour.
Yeah, it's giving Don Draper. Plus, is ESG dead? Whoa. We'll discuss the long debated corporate term and if it still holds. You don't want to miss that. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
When will the AI bubble burst?
So we're not going to continue to see this type of price appreciation like we've seen this year. But in terms of a bubble bursting, I think AI as a technology is something that's going to become pervasive in many, many parts of our lives and different parts of the market. So right now, it's obviously something that's very focused on a few stocks. I think it's going to get a lot more broadened out. So I wouldn't call it a bubble bursting. I would just call it something that's more pervasive across different sectors of the economy.
Welcome back. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman and Rochelle Akufo joining us for the next hour. Hey, Rochelle. We are 30 minutes into the trading day here. We've got a lot to get you updated on. First and foremost, the S&P 500 right now, it's higher by about 1% this Friday morning as we're taking a look at some of the top movers of the day. First up, Got to talk about Nike. Nike shares are slipping this morning after the retailer and the manufacturer of apparel and footwear saw profits come in lower than anticipated for the fourth quarter. Gross margins declined to 43.6%, and the company attributing the dip to higher markdowns and continued unfavorable changes in net foreign currency exchange rates.
And investors are closely watching Apple after it became the first company to surpass $3 trillion in market cap. And Citi, feeling bullish on the benchmark, it already raised its price target to a street high price target of $240.
And let's also take a look at shares of Savers Value Village after the company's public debut yesterday. Now, the thrift store retailer soared after its IPO yesterday, but is pulling back slightly today after originally pricing its shares at $18.
Well, talks of a possible recession are heating up again as the Federal Reserve eyes more interest rate hikes in the second half of the year. Investors are on edge. They're looking for the best way to position for a potential slowdown. Our next guest is staying optimistic, says it's time to embrace all of this uncertainty. Julian Emanuel, Evercore ISI Senior Managing Director, is joining us now. Julian, as I said earlier, embrace the uncertainty sounds very zen, right? And maybe that's how we should be feeling at this juncture of the year. You have been relatively positive this year at a time when many of your peers were not. And guess what? We had this first half rally. So how do we embrace the uncertainty?
Well, so again, the backdrop is perfect because the world's most iconic company hit a $3 trillion market cap today. And that's pretty zen in and of itself, as the founder would have said. But for us, it's this environment where essentially the technology stocks, the AI-centric stocks, really started a momentum market in March and into April. And the positivity of it all is this idea that you've got greater participation now, small caps in particular having a very good month. In fact, banks having a pretty good month. And so for us, what that says is even though you are in an environment where momentum markets, they take on a life of their own. We raised our price target a month ago to 44.50, thinking that it would take 7 months to get there, not 7 days. And now we're revisiting that number as we get to 44.50 again. The way to do this is if you are a bull or a bear, the option markets are so incredibly well priced that any concern you have or any sort of speculation you might wish to engage in, options are the way to go in terms of your portfolio.
And I mean, Julian, hi, Rochelle here. As we see people pouring into sort of any and every AI play that seems to pop up, what about some of the key inflection points that you think investors should be mindful of?
So again, the momentum markets are notorious for taking on a life of their own. And the best example is 1999. And so if you think about it, the same company that I just mentioned hitting a $3 trillion market cap in the summer of 1999 was down 29% to a price split adjusted of 51 cents a share versus the last price edging towards $200. So essentially, in this type of market, rather than thinking about when the AI bubble will burst, investors need to find strategies to allow them to hold these types of stocks for the long term. And that means either smaller than perhaps normal position sizes, or actually, again, using the options market to hedge for what are likely only to be short-term hiccups on the way to higher prices.
When do investors need to be able to determine that this company is not an AI beneficiary?
Well, that is one of these questions that I think, certainly we at Evercore ISI and almost all of our clients are thinking about right now. And the answer is that, like everything else, listen to what management's saying. There's lots of companies in the industrial spaces, in diverse food service, who are being very upfront about talking about how they intend to use AI to not necessarily cut costs, there's plenty of that, but also to increase efficiency and penetration of their clients and understanding of their clients those are the ones you want to stick with. And the ones that sort of skirt the issue are the ones that we would be a bit more skeptical about.
Julian, moving away from AI a bit, I mean, there's been this whole discussion about a broadening of the rally being necessary. And I want to ask you this question with a little bit of a different flavor based on something you mentioned in your most recent note. You said in one of your charts, financials are the oxygen of sustainable bull markets. Will they resuscitate? Will they?
Look, if June is any indication, it is entirely possible that they will, which is why July is very pivotal in our view. The results of the Fed CCAR came out earlier this week, and I think essentially they were much better than feared, and frankly, a momentum market on literally every measure, whether it's inflation, whether it's bank stress tests, whether it's margins, which drove a lot of the first quarter, coming in better than feared is very sufficient. And that's what we've seen in banks. And in our view, it's entirely possible that given as much of an underweight as banks have become with long-only managers, we see a move toward the banks. And on balance, that is a positive.
And of course, you mentioned the Federal Reserve there. Looking at this core PCE number that came in, obviously still sticky, not making the moves that the Fed would like at this point. And you have an empowered labor force, about 2 jobs to every 1 person. What sort of position does this put the Fed in at this point?
So it does appear that the pause is going to be a very short-lived event with the likelihood that they hike rates again in July. It's our view that that will actually be the last rate hike, not one more as is projected by recent Fed speak, simply because we do think that the economy will start the process of slowing down, and that will change the trajectory. But again, from the Fed's point of view, they are likely to continue walking that very fine line between trying to set the economy towards a more sustainable pace versus what has happened throughout history is that the Fed keeps going until something breaks, which is why, again, as much as we might like to enjoy summer vacation, both the data incoming and the share price action are going to be very informative about the probability and the nearbyness or further outness of a recession.
That's some serious non-swimming pool cold water on people's summer vacations, Julian. We don't love to hear that, but it's reality too. And so for many of those summer vacations, there are going to be conversations around the pool, around the barbecue and the grill, around what the reality of the Fed's actions might actually trigger an employment situation that becomes a little bit more not dire, but perhaps worsens from the point that we've seen things stable at right now?
So the first key is you need to go to beaches and mountains where there's good cell phone reception. That will work. But more importantly for us, the key metric here in an environment where, frankly, the pandemic and all the monetary creation we've had over the last 3 years has distorted a lot of the data and its meaning. The weekly jobless claims, that Thursday at 8:30 number, very, very key. To us, you've had this ratchet higher to where the 4-week moving average is in the neighborhood of 250,000, certainly off the bottom, not recession by any stretch of the imagination. The Fed would probably like to see that creep higher. However, it's one of those situations where you start moving sustainably above 300,000 a week, and then recession really draws nearer. We're not there yet, but that is, if anything, the key statistic to watch.
So, Julian, we have the overall framework here. I want to circle back around to finish us up with some strategy and get from you your best idea going into the end of the year, whether it's a sector or strategy, and like what you want to avoid at all costs.
So, again, part of the difficulty of this environment is the need to think long-term, and that works for people who do or don't own some of the biggest winners and do or don't own some of the biggest laggards. So frankly, when we think about it, there's almost a barbell effect. We want to stay convex to those types of AI stocks. We call them momentum masters, who have exhibited good price momentum. There are some names that have less, actually more defensive positioning, as opposed to the types where we've already seen fear of missing out. Those names, again, across a smattering, obviously tech-centric, are the types of names we want to stay convex to. But also when we look at a sector, again, with this idea that maybe, just maybe, the recession moves further out in time, a sector like energy, which has been more or less left for dead in the wake of last year's big run, is already pricing in a recession. And we see stability in and around $70 a barrel, and we see free cash flow being extremely robust in these companies. We like those names.
All right, we do appreciate you joining us. We'll be keeping an eye on those sectors you mentioned there. Julian Emmanuel, Evercore ISI Senior Managing Director. Have a great weekend.
Thank you, too.
You're very welcome. All right, your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
What's your favorite summer blockbuster?
Summer blockbuster. So I have been binging Never Have I Ever, which is fantastic. If people haven't seen it, it's really good as an Indian person to have representation like that. So that's probably one of the reasons I love it. Yeah, so I'm going to say watch Never Have I Ever. Oh, the other one, Platonic. That's a new one that's pretty funny.
Really?
Yeah.
Where's that on?
It's also, I think, Netflix. It's got Rose Byrne, who's just so, and Seth Rogen. Like, they're both so good. That's another good one.
Into that. All right, I got to check that out.
Bitcoin has been on a tear year to date, up over 80%. The cryptocurrency has held steady around $30,000 for a little over a week, though dipped below $30,000 this morning. Now, crypto took a beating last year following the collapse of FTX and the arrest of the platform's leader, Sam Bankman-Fried. But the price has held steady despite some volatility in the sector this year. The largest crypto platform in the world, Binance, and its founder, Changpeng Zhao, often called CZ, has been in hot water of late, all across the headlines. Now, here in the US, the Binance and CZ have faced probes from the IRS and DOJ, as well as lawsuits from the CFTC and the SEC. Recent suits accuse both of operating illegally in the US, misusing customers' funds, and market manipulation. Well, our next guest just published a report on the whereabouts of CZ, saying the billionaire is currently hunkered down in Dubai as French prosecutors investigate his crypto exchange for alleged money laundering. Joining us now is Bradley Sachs, Semaphore finance reporter. Good to have you on, Bradley, and we're going to get to CZ in just a second here, but we're looking at this recent report from the Wall Street Journal about the spot Bitcoin applications recently from BlackRock and Fidelity Investments. The sources there saying that the filings aren't sufficiently clear and comprehensive. We saw Bitcoin tumble on that news, dipped below 30, creeping its way back up. But what does this really mean then in terms of where crypto is right now?
It's a very odd space to be in for the industry because we've seen regulators, especially in the US, push against this industry. And, I think the SEC has been very clear that there's maybe not even a future for the industry in the country. Yet we have institutional players, BlackRock, Fidelity, Deutsche Bank has filed to be a crypto custodian, distressed debt investors who are making plays on FTX and other bankrupt crypto company assets, who seem to still think there's a future for this industry, that there's still money to be made, that their clients at least want access to these markets. And so there's this really fascinating tug and pull between regulators who either don't want to deal with this or setting very arbitrary laws. Coinbase obviously has been fighting with the SEC for I don't even know how long now, but it's been that kind of no holds bar type fight, and that would typically scare away a big, massive, risk-averse company like BlackRock, and they've kind of gone full bore into it. And the SEC still, with players like BlackRock, players like Fidelity, interested in the space, is still taking its sweet time and getting to anything resembling a crypto-positive regulation, which. And we've reported this as well as some before. It's pushed these crypto companies to look abroad. We've obviously seen VCs go to London. Binance is obviously been pushed to different parts around the world as we've reported, whether that's Paris, where it's now not as welcome anymore, or the Middle East, or different parts in Asia. And so if you're a venture capitalist in the U.S. looking to invest in crypto companies, you're probably looking outside the States right now.
Well, the absence of an asset approved by the SEC for institutional investors to really just pour funds into, will that lead to a further decline in the crypto reaction that we see in some of the more traditional large coins, Bitcoin and Ether or Ethereum, or whatever the household debate is at some of those levels?
Yeah, I think the actual coins themselves have become so entrenched in a lot of U.S.-based investors' portfolios, but also global portfolios, that I don't know how much a spot ETF from Fidelity is really going to matter to a global investor who wants that exposure into their portfolio. There's obviously going to be ways for them to access the big major coins. I think what a lack of regulatory agreement between the industry and even some of these large institutional players will mean is that new startups, new innovation in Web3 and new innovation in crypto is not going to happen necessarily in the States if this is the path that regulators take. It's going to push them to Southeast Asia. It's going to push them to the Middle East. And I think for a lot of venture capital investors, at the very least, that is the trend they're monitoring more so than will Fidelity ETF change the price of Bitcoin day to day.
Hey, Brad, it's Julie here. It's so interesting to me, this moment in time with these institutional investors making these filings at the same time that CZ is sort of bunkered, as you put it, right, in the Mideast. and as you have the SEC pushing back against all of this, I mean, when you talk to institutional investors, where is their interest in this coming from at this point? Because it does seem like, because of the scandals and just popular discourse, has been less crypto friendly. So it's interesting that they're sort of trying to make inroads now.
Yeah, I have been, I guess, surprised at some points too, because you see kind of like the leading figures in the industry continue to get in trouble, whether that was SBF last fall or CZ now, where there is scandal kind of swirling around the people that you put as like, the Jamie Dimon of crypto or the Warren Buffett of crypto. At the same time, I think these institutional investors are being driven by their clients who, whether they believe in the blockchain technology or just want to have access to this market and don't want to miss out on pretty significant gains, they're responding to their clients' demands. And right now their clients are saying, we don't know what this is, but we don't want to miss the train. And we trust that these big institutions can do this in a risk-averse way, or at least a way that minimizes some of the risk on us, so we don't have to invest directly into even maybe they are investing directly into a Bitcoin or Ethereum, but we don't have to invest directly into whatever is the big crypto startup of the day. We can invest through a fund. We can invest through a kind of managed portfolio where you trust that the people at these institutions know what they're doing. And then in turn, that requires institutions to find people who are knowledgeable about the industry, who are interfacing with regulators and understanding what the risks are, and who are looking most likely outside the States.
All right, Bradley Sachs, Semaphore finance reporter from One Bradley to Another. Great to have you here with us today. Appreciate it. And everyone, stick around. We've got all your markets actions straight ahead. Stay tuned. You're watching Yahoo Finance.
Summer reading lists, big thing.
Yes, big thing. So I read a lot. What is the opposite of a beach read is the book that I just finished. It's called The Covenant of Water, 724 pages. I gave it 5 on Goodreads. I'm avid when it comes to rating things on Goodreads, and I'm a strict grader. So that one, check it out. But it is the opposite of a light and breezy summer book, but it's fantastic.
What has been your best Goodreads book then?
I would say the best, Midnight Library by Matt Haig was another one that got a 5. I'm also going to say in the non-fiction category, Outlive by Peter Mattia, which talks about how we can increase our health span. And then John Hilsenrath's Yellen, that is fantastic, and also got a 5 last year.
Welcome back. Oil prices are on the move this morning and moving higher as we near the end of the first half of 2023. And Brent crude has had a rocky start, on track for its worst run of quarterly losses on record as elevated supply and concerns over demand hit prices. Let's bring in Claudio Galimberti, who is the Rystad Energy SVP and head of America's research, for more on this. All right, so just kind of broad strokes here. What most notably should we take away from or extrapolate from the first half of 2023?
Thank you for inviting me back. Well, it's been indeed a rocky ride for the past 6 months, because you will recall that we started the year at a much higher level, and then there has been for the past, I would say, 2 quarters, a negative risk premium in the market. There has been a lot of uncertainty about one key demand area, which is China. Now, we need to be aware that the first quarter of China, when I look at the actual data, was actually strong. And the real-time data that we have also shows that the situation in China is still under control. There also is a question about the OPEC Plus, what OPEC Plus is doing. One thing are the pledges, another thing is the total oil which is produced. But what I would say is that we are probably going into a second half of the year when we will see tightening balances. So it means that our focus for oil prices is upwards. But a lot, as you pointed out, a lot of contrasting factors in the first half, and that's the reason why we have been seeing the oil price going up and down. Currently, 75. So it does look, though, that there is some sort of a floor to the oil price, and that's due to the determination of Saudi Arabia and the OPEC Plus to keep the oil prices above that level.
And Claudio, what do you think will change that? Because to your point, we already have seen some discipline on the part of OPEC Plus, and particularly in Saudi Arabia. But all that's done is place a floor. It hasn't certainly caused oil prices to take off. So where do you see more supply coming out of the market that might cause that?
Well, first of all, Saudi Arabia made it very clear that between now and the end of the year, they can voluntarily and unilaterally take off the market every month 1 million barrels. So that's what I would call a very strong put option. I wouldn't bet against it, because 1 million barrels a day is a lot of volume that comes off. So I do not expect oil prices to fall below $70 per barrel unless we are going to see very negative data from China or from other parts of the world. So that is the point number one. I would say that we also need to take into consideration what's happening in other producing part of the world. For instance, in the United States, we haven't seen a whole lot of growth. And that is very important, if you ask me. And the reason for that is that it gives OPEC Plus the confidence that they can cut volume, they can reduce volume without the fear, without the risk of losing market share to Texas, to the United States. So these two gives me confidence that we will see price going upwards. But the most important thing in the trading community is the inventory. So it is we are yet to see significant inventory draws globally. We saw some significant inventory draw this week in the United States, and that resulted in Brent and WTI bouncing back up by 3-4%. The moment we see the global crude inventories to draw significantly and consistently, this is the point in time when I expect really strong backwardation, which at the end of the day means higher oil prices.
And so what about countries like Iraq and Nigeria trying to offset, especially some of the Saudi cuts? What's that going to do to demand when you factor in things like electrification and perhaps reduce demand overall as people start to pivot to some of these other vehicles?
Well, this is an excellent question. Thank you for asking. The way I put it is as follows. We have seen a lot of electrification in the past 5 years. So as a matter of fact, the pace of electrification globally has been exponential. We were selling 1% of electric vehicle in terms of global sales in 2018 and 16% last year. So it means that every year it basically doubled. The problem is that we are already seeing a plateauing of those sales. So year to date, the total global sales of electric vehicle is below 16. It's actually 14%. So there is some problem there. It can be fixed, of course, but the pace of electrification is slowing down, at least so far this year. The second is, I would say, what is the total effect on our demand? So far, it's very limited, right? So we're talking about 0% effect on oil demand. So it's very, you can already see, but you really need to use the microscope, because imagine global oil demand is still enormous, more than 1 million barrels per day, and the effect of the electrification is in the order of a few 100,000 barrels per day. But there is another effect, which I think is more important. So if people and investors think that the electrification is displacing a lot of oil demand, and it is not, at least in the short and medium term, might not be willing to invest in oil production. So you may have a counter effect, as a matter of fact, a counterintuitive effect, which is the electrification, yes, will have an effect, but the effect is probably seen 5 years from now. And if you stop investing, then because you fear that there is already a very strong electrification, then you might end up with underinvestment in the next few years, so in the short and medium term. But overall, what I would say, as far as the electrification is concerned, is that it is going on for sure, but the effect is still relatively limited, so that we are seeing oil demand continue to grow for the next 2, 3, 5 years for sure.
Claudio, thank you for joining us. Good to see you. Claudio Galimberti is Rystad Energy SVP and head of Americas Research. Thanks.
Thank you very much.
We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
I don't eat meat, so I'm going to be having some Beyond Meat veggie burger, which if you guys haven't tried that I'm going to say is just one of the best things that has happened. Not super healthy for me probably, but just super delicious. So
Kebabs.
That is what.
Kebabs for me. But
Kebabs for you, okay.
I believe maybe some seafood kebabs.
Okay,
yeah.
I love that. Maybe I'll do some shrimp kebabs.
People, also, if you're gonna throw some corn on the grill, do it right. Make sure you wrap it up in the foil, put the butter in the foil, you gotta salt and pepper it when you put it in the foil as well. I mean, come on, we can't be out here having dry corn on the grill.
President Biden has been traveling across America, presumably this past week, on an Investing in America tour, highlighting the tenets of Bidenomics. The president seems to be hoping to draw on the support of the working class and the strength of the economy to aid his nomination for re-election. But both the right and left remain skeptical about Biden's popularity. Let's bring in Yahoo Finance's Rick Newman to dig in on the topic. Rick?
I love that introductory music. It's so chipper.
Dun, 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 dun. Yeah. There we go. So, it seems like the Bidenomics. So there's Bidenomics, your segment that you do, and now there's Bidenomics as the president has actually branded his economic plan. So how's your Bidenomics report card of his Bidenomics plan?
I rate the Biden economy better than most voters seem to rate it. And this, I know we've been talking about this for months, but it's worth repeating that the recession everybody's been expecting simply is not coming. My favorite research note of the week was by economist Bernard Baumol. He sent out a note saying, "Ladies and gentlemen, the recession has been canceled." And that's because look at the data that's coming in this week. We got a big increase in GDP for the first quarter. Jobless claims went down by 26,000. They're back to very low levels. I mean, they're supposed to be going up. We're supposed to see softening in the labor market. That is not happening. Stocks had a great first half of the year. And Biden is going around trying to tell voters that things are pretty good, and nobody really wants to hear it. They just don't really believe it, and that's reflected in Biden's popularity, which is still very low at 40%. I have to think that if the economy stays the way it is and inflation continues to come down, that we are going to see Biden's popularity tick up a little bit, because what's not to like about an economy with an unemployment rate well below 4%, and inflation that's coming back to normal?
So what is not sitting well right now? Because people are going to be having a lot of vacation week discussions next week, trying to figure out exactly where they feel with regard to what's the reality of the economic data that's come through, the spending that's been approved, that's moved through Congress, and that Biden has signed off on as well.
I mean, I don't think ordinary people pay much attention to these big programs Biden has signed.
They don't follow the wires like us?
I don't think so. I think what they might be talking about is how much the chicken or the beer costs this weekend, and if they're buying Bud Light, they might get a discount. We do know that 4th of July barbecues are going to cost a little bit less than they did last year. I think that consumers are shell-shocked by inflation, even though we know the annual inflation rate has now come down from a peak of 9% to 4%. Remember, all those price hikes that we've seen during the last 2 years are still there. It's not that prices have come down, they haven't. It's just that the rate of inflation is a lot lower than it was a year ago. And I think people also have somewhere in the back of their mind that when you have inflation and when you have the Fed hiking interest rates the way it has been doing, that normally produces a recession. That is one of the reasons economists have continually said we think a recession is coming. It's because that's what usually happens. When you have high inflation and the Fed has to hike interest rates, it chokes off borrowing, it chokes off spending, it chokes off hiring. And that's what the Fed's trying to do, is slow down the economy. And when you do it this fast or this aggressively, normally you do get a recession. I think that's why economists have been saying we still think a recession is coming. And I think that's getting through to voters. Maybe it's different this time. Maybe we are actually going to have, economists are starting to rethink their models and say maybe we can have a really strong labor market with the inflation coming down, and we're not going to have a recession.
I mean, and it's very hard to sort of time exactly when this is going to hit, especially in an election year on top of that. Do you think there's going to be enough time between what happens with early 2024 and recession fears and election time for Biden to really be able to make a strong push here? I
mean, that's the most obvious question. And I think everybody wishes they knew, but nobody does. I mean, if you go back to this time last year, we are supposed to be in a recession right now, and clearly we are not. Oxford Economics, I just saw, they said, well, we still think a recession is coming, but we're pushing it out. Instead of starting in the third quarter, which is 2 days from now, is the third quarter. We think it's going to start in the fourth quarter of 2024. Maybe it'll start, or of 23, maybe it'll start in 2024. That would be bad timing for Biden. So it's good for him that the economy is staying strong now. Of course, if all this means is that we're just delaying a recession into 2024, that's bad, because the condition of the economy in the first half of an election year it matters quite a lot for an incumbent president's reelection odds.
Rick, hang out, because there is something that's just happened that will have an effect on consumer spending. The Supreme Court out with the ruling on President Biden's student debt cancellation plans. Our Alexis Keenan has been reading through the decision, and it seems as though this is a defeat for the president and that plan.
Yeah, Julie, definitely a defeat here. There were two cases that the Supreme Court was looking at, so kind of two chances to challenge this particular plan for debt forgiveness for student loan borrowers. One was brought by 6 Republican-led states. The other was brought by 2 borrowers. Now, the court did away with the one by the 2 borrowers, saying that they don't have standing to sue. But the one they're making this decision on is the Republican states who challenged the law. And they said Missouri, which has a significant student loan servicer that stands to benefit from student loans continuing to be paid out over time, they're the ones who have the hook here and were able to keep this case in court. Now, the question was, can the Biden administration unilaterally, or really any administration, forgive federal student loan debt under the HEROES Act based on an emergency, national emergency, in this case, COVID-19 being the national emergency there. And the question was, could they do that without approval from Congress? And this court here saying no in a 6-3 decision, with Justices Kagan, Sotomayor, and Jackson dissenting, Chief Justice John Roberts writing that no, this forgiveness plan is not legal. It cannot stand under the HEROES Act. And that the administration is not authorized to offer this kind of debt forgiveness. Now, I am still reading through the decision here, and there'll be more to come. But basically what this does is it makes that plan that was to forgive up to $20,000 in federal student loan debt for borrowers whose modified adjusted gross income was under $125,000 or households up to $250,000. They were going to be able to get up to $20,000 of student loan debt wiped out, or possibly maybe just up to $10,000, depending on whether those borrowers had a Pell Grant that they had received during the course of their borrowing. Now, this impacts largely a much bigger group, 43 million borrowers, student loan borrowers in the U.S. The administration had predicted that 20 million of those borrowers could have seen some forgiveness under this plan. But also, you have to look at taxpayers. Before the court had halted this plan from going forward, you had 26 million already applied. But as for the taxpayers, the cost of this plan, it varied widely, so it's kind of hard to get your arms around it. On one hand, you had the CBO saying that it would cost $400 billion over 30 years. You also had the University of Pennsylvania estimating that it would be $300 to up to $980 billion over 10 years. So certainly taxpayers stand to be impacted greatly here as well. But these payments now for student loans, they've been on pause since early in the pandemic. So things are going to change here for the country's millions and millions of borrowers who were looking for that relief. Guys,
just looking through the filing as well, Alexis, as you've been combing through as well, it seems like the dissent led by Justice Elena Kagan, that's saying that it essentially, as of right now, from the first page to the last, the opinion departs from the demands of judicial restraint. Just help us break down exactly, perhaps, what that means as the dissent is making their case, as well as this has been a highly politicized issue going into this decision.
Yeah, so now the HEROES Act, it does say in plain English that the Education Secretary of the United States in an emergency, in a national emergency, can waive or modify federal student loan programs. So wishy-washy language around that word programs, and that's what these justices are fighting about. And as far as judicial restraint, you might have justices perhaps on both sides of the aisles, and in fact, some of the conservative justices during the questioning, during oral arguments, had said, well, you know, the language says that the education secretary has this power. So perhaps not restraining themselves properly and reading the letter of the text. But this was definitely one that was a difficult decision. Arguments were solid on both sides. But the education secretary here not being able to go it alone, the administration not being able to go it alone, it looks like if there needs to be debt relief here for student loans, it's going to have to come from congressional action.
So Alexis, what happens next then? If you're someone, you have federal loans and you've watched this ruling, what happens as of today?
Yeah, so you know that the administration has decided that the repayment for those who, let's say, would not have been eligible, but now that turned out to be everybody, it goes back into repayment in September. So those payments are going to have to be made, or other arrangements to apply for other forgiveness plans. But this particular debt relief, and there has been other debt relief that the administration has rolled out, but this debt relief is off the table. So we're looking at that $20,000 up to $20,000 per eligible borrower. But things are going to change, and there has been so much talk about the potential impact on inflation, that this could compound problems here in the United States with prices being so high, that now these borrowers are going to have to go deeper into their pockets and grab some money for student loans. And they've had this reprieve for over 2 years now.
I appreciate that update there. The Supreme Court striking down that student debt forgiveness from the Biden administration. A big thank you there to our Alexis Keenan. Well, the rise of car sharing has seen a slow and steady growth over the past few years. As we can see here, according to Statista, worldwide car sharing revenue is set to hit just over $16 billion by 2027, and the number of active users will hit over 62 million. Now, Turo has played a role in this. It's a car-sharing marketplace both online and via its app. And we've got Turo Chief Data Officer Albert Managas to speak with us here about the state of the car-sharing space. Thank you for joining us this morning here. So talk about how much this space has really developed to this point, and really the demographics that are driving this.
Absolutely. It's been really exciting to see peer-to-peer car sharing really grow over the years, and Turo has really been a leader in the industry for the past 13 years. And what we've seen is that there's a growing interest in being able to have a lot of the benefits Turo offers today, which is that extraordinary selection. Guests today can choose on Turo from a variety of cars of over 1,400 different makes and models. And we also have an unrivaled network of Turo hosts in over 11,000 cities across US, Canada, UK, France, and Australia. And so I think just having that selection and that network is something that consumers love. And there's a lot of opportunities for this to be really convenient for guests with hosts offering delivery as well.
And so for Turo, where are you seeing, even in that relationship with so many customers out there, I believe even from my own instance, trying to use Turo before, that there's an option to purchase insurance on top of your experience, that there's so many different instances where Turo can really be able to see an added margin benefit from even that one singular customer experience, but then keeping them within kind of the Turo ecosystem. How do you go about doing that, and what does the data tell you about some of those largest repeat customers?
Yeah, we're finding that Turo really satisfies a lot of different use cases. And there's a lot of different opportunities where us as Turo are able to find different revenue opportunities to our hosts as well. We actually have an ability for hosts to offer extras. And so for the 4th of July weekend, if folks are looking for some additional things to add to their trip and hosts have it, they can add that to the trip and make it really convenient for travelers to be able to have access, whether that's that surfboard or maybe they need that extra cooler, and they can throw that into the trip as well. And so exciting to see there's a lot of different types of opportunities for travelers to, again, find a lot of the things they're looking for in terms of cars, but really enhancing that travel experience.
Albert, presumably a lot of your customers are under economic pressure right now, right? Inflation's been going up. They've had to make some hard choices about how they're going to be spending their money. And maybe now that choice has gotten even harder with this new ruling from the Supreme Court that we just learned about, that those who have student debt who haven't been paying it are going to have to start repaying as of September. I imagine a lot of your customers and potential customers have student debt. How is this going to affect your business?
Great question. So I think there's two sides of this. There is actually a survey from Bankrate that reports that despite these elevated interest rates and these pressures, 63% of U.S. adults still plan on traveling this summer. And that's actually up from 61% last year. But with more Americans looking to travel this summer, many of them are looking ways to cut back on travel costs. And one of the ways that we've seen and has really risen in the use case for Turo is many folks are looking to do road trips and opting to drive instead of flying to their destination to be able to cut back on costs. On the other side, as a host, Turo is changing the economics of car ownership. And so instead of having these cars that typically sit idle 95% of the time, Turo is transforming what's traditionally a depreciating asset that's sitting there in your garage or parking lot, and putting money back into host pockets. So in terms of hosts, this is allowing them to offset, if not actually make a profit by listing their car on Turo. So it's been exciting to be a part of that.
And what about, obviously, people are going to have to pay for the maintenance on their cars to be able to be hosts. If money's a little bit tight, are there any sort of incentives or anything that you offer, say, obviously, when people do Uber and there's incentives there, is there anything that Turo offers that would really help offset some of these additional costs that people have in maintaining their vehicles?
Yeah, I'd say just by simply listing on Turo, this is what is covering not only the, in some cases, the monthly financing, the insurance, as well as maintenance. Like all of that is hosts are able to actually recoup a lot of these costs just by listing on Turo. There's not even need to do any of these incentives, which is great. But time to time, and we will announce with our host community different types of incentives depending on where you are. But as of right now, I'd say that those incentives aren't even necessary for hosts to be able to make a profit and really grow their business.
And obviously, it's huge travel season coming up. You have the July 4th weekend. So for 4th of July, as people are sort of figuring out how they should go about either renting a car or doing something else, or even the hot spots where they can sort of get the most bang for their buck, what are the key findings that you're seeing this summer travel season?
Yeah, I think travel experts are expecting this holiday weekend to be one of the biggest ever for 4th of July. And so there's going to be a record number of people traveling. And again, one of the unfortunate challenges of that is that there actually has been an increased number of flight delays and cancellations. And so again, one of our biggest recommendations for folks who haven't booked their travel for this weekend yet is to think about doing a road trip. This is a way to kind of cut back on the flight costs, but still be able to experience and get outside and try a little different. Try to do different things with an exciting selection from Turo. And there's a lot of local Turo hosts still available with cars available for this weekend. And again, there's a lot of different destinations that we're in and across 11,000 cities. But I'd say the top destinations this coming weekend are LA, Hawaii, Denver, Orlando, Miami, as well as San Francisco.
I mean, that would be a long road trip from DC to Hawaii, but obviously people have options that are closer to home. A big thank you there to Turo Chief Data Officer Albert Mangajas. Thank you so much.
Thanks for having me.
All right, stay with us. You're so welcome. All right, stay with us. We have all your markets actions still ahead. Stay tuned. You're watching Yahoo Finance.
Are we going to see a recession this year?
Ooh. Good question. Comes up a lot. I'm going to say for 2023, not likely. 2024, more likely.
I'm going to say that we will know if there was a recession this year after the NBER declares that there was a recession that we entered into this year, which will likely come well after the fact.
Fair enough.
ESG has been making the headlines, but what does it actually mean? Well, the concept is simple. Make investment decisions based on corporate policies. So let's break it down for you. E stands for environmental, a company's initiatives to fight climate change and become more green. S is for social, how the company treats its employees and the community that it serves. And finally, G, governance, the company's leadership and decision-making. Now, the movement has become a big part of the investment landscape, attracting trillions of dollars in investment, but the doubters say it's become little more than virtue signaling. So can conscientious capitalism live on? Well, it's time for Yahoo Finance's debate. Over to Julie Hyman, Brad Smith, Rick Newman, and Jared Blickery. Hey, guys.
Hey, thanks, Rochelle. Appreciate it. So ESG, the reason that it has come up even more so recently is that there has been sort of a battle, if you will, between investment managers and, for that matter, some pension plans that want ESG to be part of their investment decisions, and then some states or other figures who do not. And Rick, you wrote about this week that Larry Fink of BlackRock, of course, basically said, I'm not saying ESG anymore.
And that's important because Larry Fink has been one of the biggest proponents of ESG investing, and BlackRock is huge. So if BlackRock is actually doing this, many other investment managers have to follow. Specifically, think about Ron DeSantis. I mean, he has declared what he calls this war on woke capitalism. That is pushback against ESG investing and other things that might be related to ESG investing. And the state of Florida has actually said some of their teacher funds or things like that, they actually do not want going to any investing firm that practices ESG investing. So that's the blowback. So what is Larry Fink talking about? I don't think we know. Is he just going to rebrand it? I mean, is it going to be the same philosophy? It kind of look for these virtuous companies, as you might call them, or is he actually going to change his focus? I don't think we know that yet, but that's what's at stake here.
Well, what he said in the past is that climate risk is investment risk, is portfolio risk, and he had correlated the two. So if we kind of separate the E side from the S side of ESG, where that's where you get into the more politicized annexation of woke, which has been co-opted and perhaps so muddled to the point where it is distant and deviant from the actual meaning of where companies were more values-based, where they were trying to be more conscious about the consumers that they were serving, and growing out a more global or even just more diverse client base as well, which investors should look at and say, hey, potentially that means growth for the business. Potentially that means expansion of the market. But instead, that's been pushed to a different direction.
Yeah, and you're looking at the money that we've seen in these things, right?
Exactly, and to your point here, the rise of ESG, I think 2019 was probably a breakout year. That's when we saw a lot of ESG outperformance as well. And so these investments, which had been considered fringe, suddenly they're outperforming the S&P 500 in 2019, even 2020, I believe. But then they took a back seat. And I'm going to show the Wi-Fi Interactive here. I have an ESG funds heat map, and so everything's equal weighted here because we're not dealing with market cap. But in the upper left, GSPC, that is the S&P 500. This is year to date. It's up over 15%. Very impressive. You'll notice that all these ESG funds, these are underperforming. Even the top one just underperforming by a little bit. This covers the USA. This is iShares. This is a ESG ETF for them. Now you take a look over the last year, you're going to see even more underperformance. You got some red there. And then 2 years, it's looking really bad because we go back 2 years ago, that was when a lot of stocks were topping. One of these down, XOSC, down 33%. And then 3 years, still, the S&P 500 comes out on top. So it's definitely been outperforming, and that has been diminishing some of the arguments pro-ESG. Now, I have a couple of notes here I want to show on the Wi-Fi Interactive as well. This is from Sanford Bernstein. I'm going to highlight some text here on the Wi-Fi Interactive. The term ESG was first coined in 2005. Fast forward today, ESG investing is at a crossroads, and they highlight some of the political uncertainty that leads to it. And here's the key line. The term may change, but the concept of ESG has been around for over 200 years and has been reinvented multiple times. Now, I want to show another source here. This is from Goldman. Energy firms' focus has shifted from ESG to energy security, and we can see in this chart going back to 2010, the cyan line here, which has just risen meteorically here, and that comes with the timing of the conflict from Russia and Ukraine. That has shot up, and it has overtaken the concerns, the interest in ESG. So there's a switching of paths here. where the rubber met the road and people had to confront the reality that, yes, energy security is important. Now, can these two concepts be merged? Can we go back and maybe have a best of all worlds here? I would like to think so, but it's an evolving concept, I guess is my point here.
I think the evolution of the concept argues against the concept completely.
Really?
So I've followed the energy markets a lot during the last year. So and they are a target of so-called ESG investing, right? So defund fossil fuels and so on. Interesting concept. I mean, I certainly don't argue with the fact that we need to decrease the amount of carbon in the atmosphere and deal with global warming. But at what cost? Are we willing to have shortages of fossil fuels that we need right now? Actually, no. So gasoline prices hit $5 in part because energy firms don't want to invest in drilling anymore because their industry is under attack and they see what's happening. I mean, we're shifting over to renewables and even government policies now support that. So they don't want to invest in new capacity. They want to give money back to shareholders, and we end up with skyrocketing energy prices, and that undermines public support for the whole thing.
There is a new crop of investors, though, folks like at Engine Number One Capital. Yes. Who are pushing internally, not to defund energy, but to be shareholders of these companies and internally push for changes, push for increasing investment in renewables.
And they have 1 or 2 board seats at Exxon now,
yes.
Right? And they're supported by the California Teachers Pension Fund, so that's where it's coming from.
There are different ways that people have been pushing for this.
This highlights a problem. So some traditional energy firms are doing more for renewables than others. How do you fit that into your ESG portfolio? Do you say BP is in the ESG portfolio, but ExxonMobil is out? What's your threshold for green energy
I think it depends on the portfolio. I mean, just to take a step back here, one of the other older terms for this is stakeholder capitalism, right? Is that when you're investing in a company, you shouldn't just be considering the bottom line and the return, to your point on that heat map that we get, that's not the only thing that you should consider. You should consider whether the company is a good corporate citizen, for lack of a better term. Is it helping to, promote environmental, social, and governance goals? And I think if that's how somebody wants to invest, that's a valid goal. If that is if that's how somebody wants to invest, recognizing that just the bottom line is not the only thing that you're assessing.
And the other part of this too is where for individual investors are they looking at companies that are not trying to make such a drastic shift, but are starting out with that as a North Star and saying, we're going to bring the rest of the industry with us, or at least putting pressure on the rest of the industry to make a change or to recognize that there's a clear clientele there. Take Tesla, for instance, a company that made somehow electric vehicles sexy by coming in at the top end of the kind of luxury model there and then saying, all right, now we're going to make this more approachable for everyone else. They've never moved off of their environmental vision or that goal, but they have brought a lot of other traditional combustion engine manufacturers along with them into that space because they are now realizing that they're going to miss out on that wave.
Also non-union.
Also non-union.
So how do you square that?
That's a good.
So I would like to introduce one other factor. So you said 2019, sort of the peak for ESG
right,
investing.
And also a peak in the growth stocks, critically because those were considered ESG stocks like Apple, Meta. Those were considered ESG just because they were not Exxon. So that gets back to the shifting definition of the very term.
Okay, so Donald Trump was president in 2019. The U.S. was doing basically nothing to address global warming and climate change. Joe Biden comes in. We now have the most aggressive U.S. effort to address global warming and climate change ever with the Inflation Reduction Act, all these incentives for green energy. If you care, I mean, these goals are important. I think we probably all agree all these goals of ESG investing are important. The question is, should you go after them through investing? And there are other ways to go after these goals. Activists do it through boycotting companies or calling attention to practices they don't like. We now have massive government intervention in the market with literally hundreds of billions of dollars of incentives for green energy. That is going to be way more effective than ESG investing portfolios. Absolutely.
Yeah, I mean, that's a really good point. And that's a good point that the inflection here now, a little bit away from ESG, comes at a time when the government stepping in and doing the job.
There was a perception before the Biden administration that was accurate that the government's not doing anything here. So let's see if we can muster some private sector incentives to do this.
There's one element of this that we haven't talked so much about, and that's the idea of so-called greenwashing, or whatever term you want to apply to it, which is that when we had the upsurge in interest in ESG and companies wanted to be thought of as ESG, they would put this language in their statements and on their conference calls. Were they really adhering to this? I mean, you bring up big cap tech, which also are incredible consumers of energy. You think about data centers and the energy that they use. That is a very energy inefficient business. So, you know, there's also that idea, and this kind of goes to your point as well, Rick, that it's really difficult to say this company is adhering to ESG or it's doing it in one area but not doing it in another area, and how do you weigh all of that?
And companies change.
Sure.
Well, and then they had loopholes that they could move around with cap and trade previously about 10 years ago.
Well, now it's buying pollution credits.
Exactly.
I mean,
that's financial engineering, by the way. Jack Welch would have given anything for carbon credits. Let me tell you.
Jack Welch, that paragon of ESG.
Yeah.
But I mean, at the end of the day, for the amount of companies that are sensing where they can satisfy investors or satisfy the narrative that they've put forward to client bases by saying, well, here's a loophole that we could just buy into, for the amount of offsets that we can purchase instead of actually changing the operation, that's perhaps going to upset investors, because then it will upset what our margins actually look like.
Greenwashing is definitely a thing. It happens. I mean, as a reporter, I've tried to look into this. It's hard. And I can't imagine how any ordinary person who has a day job and just looks at his or her portfolio and tries to pick stocks here and there, you know, evenings and weekends, could ever figure this out. So yes, you can rely on investment managers to do that work for you. I don't really have a lot of trust that even the investment managers can keep up with it. There are just better ways to go after these goals. And you know, to go back to what I've been following a lot, which is the war on woke capitalism. This is, we have a massive culture clash in the United States these days that is just going to continue, and CEOs are constantly having to figure out, this is mostly social issues, which is, you know, 1/3 of ESG. CEOs are constantly having to figure out where to take a stand on social issues, where not to take a stand. Of course, we saw this blow up with Bud Light, trying to support the trans community and then getting pushback for that. The struggle is part of the process. The struggle, these battles between activists saying that companies should do this and the companies saying, oh, we really don't want to get involved. This is normal. This is actually how cultures evolve, and it's part of the process. So it's messy.
Do you see it as cyclical, though? Because it seems like activism has been on the rise over the last few years, and maybe it's just a secular thing that changes with the generations, but it seems like all that activism has been increasing recently.
It certainly has been politicized. Right. For a lot of reasons we all know about: social media, cable news, the Trump effect. So everything gets politicized, and you know there are always controversies that companies get sucked into unaware, and they never thought they had to have a plan for. I mean, it used to be support. You know, Delta gave discounts to NRA members, and they canceled that, and then they had a big fight with gun owners. I mean, there's always going to be an issue, and you know what? Consumers just want their brands, if to the extent they care about them, to be authentic. Right. They want you to just kind of evolve with the culture, and maybe when you have to step up and take the shot. A lot of CEOs don't want to take a stance on these issues, clearly.
Bud Light is a very good example of that.
Yeah, and they're a good example because they wavered on it.
Yes.
And for companies that have shown that they're willing to be performative in Bud Light's case, and I use that specifically because it was pure performance, because they did not stand by what they were putting out in their messaging. That was a mistake. And it was a mistake. It's proven to be a mistake.
So that should have been part of the plan all along. Right. This is going to be controversial. We need to anticipate it. What's our response going to be if we get attacked for this?
Nike, one of the early companies that did that many years ago, Colin Kaepernick, and the campaign, which went viral, standing for something, even if it meant sacrificing anything. You think about the companies that have had to actually stand by it and have done it well. You mentioned Delta. Their CEO, Ed Bastian, has been very vocal about, even going into an election year, they were not going to sacrifice their values and their business in order for profit. They are going to make sure that their purpose is also driving profit at the end of the day as well.
Of course, the other example here is Disney, which is having this ongoing legal battle with Ron DeSantis in Florida. They also made the mistake, which is they were wishy-washy at the beginning. But then they changed
that's part
CEOs.
of what cost Chapek his job, right?
That's
Is that he was wishy-washy in the beginning.
And now they are fighting with both fists, and they are just saying, we're going to take this on completely. So that they got to where they need to be.
And I think just to put a pin in this, it's very interesting the conversation we're having, which went from sort of investor, what investors are prioritizing to what consumers are prioritizing in the case of these very consumer-facing brands. And then, of course, it comes back around to investors again, because if it costs them, as it did in the case of Bud Light, or seemingly in the case of Disney, they seem to have come out on top of this, then, what is it going to do for their bottom line? Yeah. And that's what we like to focus on. All right, that does it for us. We are going to send it back to Rochelle, I think.